Joining me now on a Fox Business exclusive, Republican Chairman of the House Financial Services Committee, French Hill. He was also founder, chairman, and chief executive officer of Delta Trust and Banking Corporation for about 15 years. So you understand banking, you understand risk. How closely, Congressman, are you monitoring this rush for the exits by investors looking to pull their money out of private credit funds?
Well, Liz, thanks for inviting me today. I think it's something that on our committee we're monitoring closely on the impact on the depository banking institutions as well as the impact on the funds. And, you know, over my 40-year financial career, it's always something that each individual investor, whether you're an institutional investor or an individual investor, you have to really allocate your resources carefully to have diversification in case there is some market swoon or particular credit matter in any particular investment that could imperil it in the short or long run. So it is an important issue. It's one that we've been in conversations with both bank and non-bank financial providers over many, many months about assessing the direction of the industry. And like you've noted, we're monitoring it closely.
That is great. And I'm very interested to know, though, if there is some type of plan that is being formulated, because a lot of these pure play private credit companies are lightly regulated because they're not really banks. So give me a sense of whether regulation might be coming. You don't want to wait till the house is on fire before you start to call the fire department when you see some smoke.
Right. Well, you know, in my view, one of the contributors to the robust growth in private credit funds was the result of regulation coming out of the 2008 crisis that raised capital standards and made it very difficult from a capital allocation point of view for our traditional commercial banks to be in this segment of the higher yielding commercial lending business, both in not only leveraged buyouts, but other contracts for lending as well. And so, you know, in some regard, this concentration is a result of regulation. So I think before one snaps to judgment about whether they should have regulations added, we ought to assess what's the pattern, what's the contribution, what's the nature of the challenge, and let's also focus on what's being impacted by retail investors versus sophisticated institutional investors too. I think that's an important distinction in some of the instances that are being noted.
How much of the onus rests with the investor who buys into these funds? Because somewhere, and whether it's fine print or not, it's there, that these are not totally liquid funds. Although I've heard from some bankers who said, no, they were promoted as liquid, meaning you can get your money out when you want to. But in most cases, these investors were told, because of the underlying loans to some of these companies out there, many of them not publicly traded. And the problem lately is that so many of the loans have gone to software companies, which have, of course, been in real trouble lately. How much is the onus on the investor to say, wait, I should know what I'm investing in, because just cashing out those loans and getting my money back is a lot longer a process?
Well, in the sophisticated private placement arena, we count on that investor to take that responsibility in a major way because those disclosures are geared towards a sophisticated investor, either institutional or high net worth individual. In the public markets, you have some of these entities that you've cited that are engaged in the private credit business, but their stocks are publicly traded and then, as a result, widely held by a number of different funds in the financial services space. So it's an issue that's impacting both just the common stock owner of someone in the financial services space who's disproportionately allocated in private credit, and the issue you raise on those who've invested in a fund, a private fund that has some rules in the limited partnership or LLC agreement about redemptions. So all of those are complicated. I always say my best advice after 40 years of being in the business is I really do think individuals who are making that buying decision need to really think long and hard how that investment fits in with their plan, their allocation, their risk tolerance, and their investment parameters. So, but with that said, you know, our public markets have very rigorous, intensive disclosure requirements. And in the sophisticated institutional market, those are mostly covered by very well-established terms that are derived by competition in designing those partnerships.
Well, okay, so I'm hearing you say that the problem was overly regulated banks. So investors then went to other, borrowers then went to other types of companies like the Blue Owls of the world to get money, albeit at a higher rate, and then investors piled into those, et cetera. Let me dovetail to crypto regulation, because the U.S. banking industry has effectively lobbied to halt the crypto industry's market structure bill. They don't like the part of the Clarity Act that provides too much freedom to the crypto companies and still holds banks to much tighter regulation. Where does this stand, Congressman?
Well, in the House last July, we passed the Genius Act that created the first U.S. dollar-backed payment stablecoin, and we passed the Clarity Act in the House with 78 Democratic votes. In both instances, on a bipartisan basis, we said that stablecoins should not pay yield, that it's just a payment device to be used on a blockchain.
Right.
And we also outlined in the Genius Act that both bank and non-bank issuers of a dollar-backed stablecoin would be treated the same way on sales practices, capital, supervision. So in my view, this can be resolved in the Clarity Act, and I hope soon. My recommendation is that all these issues around paying yield or connecting rewards by either a bank or a non-bank issuer should be dealt with in the regulatory proposal that Treasury has to come up with to implement the Genius Act. I think it's best resolved there, but I think it could be emphasized in the debate in the Senate's consideration of Clarity, where they lay that out in statute, that we want equal treatment between bank and non-bank issuers of stablecoins and how the sales practices are used by both sides. I think we can find a way to do that. JP
Morgan CEO Jamie Dimon, who was reportedly pretty annoyed and didn't like the Clarity Act because he said, how is this fair that we banks have to be held to such tight regulations, and then you've got the crypto companies, they get the same opportunities, but they don't have to be regulated. He says there's an opportunity for compromise, and I'm wondering if you agree. He said rewards on stablecoin transactions would be something that would mark a compromise versus just idle yield being handed out.
Yeah, exactly. And I think, in my judgment, that could be handled through the rulemaking that's being considered by the U.S. Treasury Department to implement the Genius Act. But in the Senate's consideration of Clarity, they could outline that in statute. And I think that's, that's headed in the right direction towards a compromise. Because my view, on a bicameral, bipartisan basis for several years now, and certainly the last several months, we've said that all issuers should be treated the same way. So you don't want to have an imbalance between people using a dollar-backed stablecoin on their platform if they're a bank versus a non-bank, in my view, my personal view.
You are running for re-election during the midterms, and we're in the midst of this affordability discussion, let's call it that, demand, depending on, what income rate people are at. And it is very much a concern for people. Right now, we've got oil skyrocketing. Gasoline is right behind, tracking that, because crude is the pace car for what we're looking at for wholesale gasoline and for retail gasoline. What is your message to investors about affordability? Because in the past, President Trump has mocked the term. He's mocked Democrats. He's also called it a hoax. But he's also, in some speeches, said, now I'm on an affordability tour. Which is it?
Well, first, in my work in the House, I've done three things I think that directly relate to affordability. One, I wrote the Price Stability Act, which says that the Federal Reserve should be focused on fighting inflation, because inflation is the worst tax of all. It's the one that we have the least control over. If the government spends too much money and creates macro inflation, that's punishing to everybody, institutions, the government itself, and of course every family. And we've been recovering from a 40-year high in inflation during the Biden administration, with it slowly coming down. So that's point one. Point two, I've authored a bill called Main Street Capital Access that encourages community banks to be out making more loans and adding more capital to things like housing construction, local businesses, which increases supply, which brings down prices. And finally, our 21st Century Housing Act that we passed in the House with 390 votes directly tackles the cost per square foot of constructing new housing. So we're taking legislative action to bring down prices, but I don't want to underestimate two other pieces. One, getting the federal budget under control, which drives up inflation, and two, don't forget the power of the big, beautiful bill passed by House Republicans. All the Democrats voted no on it last year, and that's seeing increased real earnings through lower effective tax rates for Americans all across the income curve, better child care support, better opportunities to invest in small business. So I think you're seeing real earnings up this year and inflation trending down. And I believe the terrible impact on the crude market, I hope, I'm knocking on wood on television, will be temporary as we end the fighting across the Persian Gulf.
Yeah, right now, light sweet crude at $95.90. Hopefully it is so-called transitory, short-lived. We'll watch it. Congressman French Hill, thank you for coming back on the show. We'll see you next time.
Thanks, Liz. Great to be with you.
Anytime.